Hey y'all, it's Sherrika, the realtor, and today I'm with Jenay with Summit Funding, and we're going to answer hopefully some questions that may have crossed your mind about the home buying process. So I met Jenay back in 2008 when I bought my first home, and I've been in touch and using her since. So today I'm gonna ask her some questions as the consumer and let her answer them. Hopefully we'll touch on something that you have questions about. What is the lowest score I can get approved with?
So the lowest score that you could get approved for would be a 580 credit score. That's really the lowest that we can do. That also allows for minimum down payment, which would be a 3.5% down payment on a purchase price.
580. So that's what Summit Funding can do.
Yeah, so actually what you'll hear kind of in the market, you'll hear some lenders say 620, 600, 630. The difference is not every lender is created equal. And so if you're hearing different numbers in the market, different credit score requirements in the market, it's because that lender specifically won't allow to go down to a certain credit score. So these are FHA loans. Here at Summit Funding, we really do truly follow whatever Fannie Mae, Freddie Mac, or Ginnie Mae puts out there, FHA. We're directly insured with them, so that allows us to go to these lower credit scores. So FHA says, hey, if you have a 580 credit score, you can do a minimum of 3.5% down payment. So that's what we did.
Okay. So does my credit score affect my interest rate?
Yes, it does. Great question. It's kind of like buying a car, right? Kind of think of it the same way. Higher credit scores, you've got a little bit better buying power. You've proven yourself a little bit more in the market. So therefore, you're going to get some better interest rates than you would if you had that 580 credit score.
Right. Okay.
Now, let's talk about that though, because sometimes some people think, I'm going to get charged 10% if the going interest rate is 4%. No, that's not the case. If the going market rate is 4%, you may be at 4.75% or 5%. It's not going to be a huge difference, but that is a perception in the market that some people think it's going to be really high.
Right, that's good. Okay, what type of loans do I have to choose from?
So lots of different loans. So I could go on probably for a long time on this one, but I'll narrow it down to a couple of things. You've got FHA government loans, FHA, VA, and USDA loans. You have conventional loans, which are Fannie Mae and Freddie Mac insured loans. And then we also have what we consider kind of more of your non-traditional or portfolio type of loans, where you don't meet the standard criteria for qualifying. And somebody that may be self-employed writes off a lot of expenses. We have things like bank statement loans, asset depletion loans, and multiple others there. But there are some other sources if we don't meet those traditional type of financing.
And who qualifies, or what score do you need for a conventional?
So conventional, Fannie and Freddie says 620. So the minimum for a conventional loan is 620.
And conventional is what, about 5% down? I saw 3.
Yes, so you can do as little as 3% down for a conventional loan. Not everybody qualifies for the 3% down. So you kind of, if you wanted a standard answer, 5% down, everybody qualifies for that, because you're 3% down, you've got to be a first-time home buyer, or you got to meet a certain income eligibility to qualify for the 3% down option.
Okay, gotcha. So next, how do I know? Well, I guess we kind of answered that. How do I know which loan is better for me?
Yes. So I always say there's 3 things when it goes into qualifying, and that's cash, credit, and income. How much cash do you have available that you can use for a down payment towards the purchase of the house? What is your credit scores? But not only the credit scores, but the overall condition of the credit and the debt on your credit report. And then the last item is your income, and it's qualifying income that we can use. So once we've determined and established those 3, cash, credit, and income, that really will determine which loan program is best for you. So those are the things. Higher down payment options. Typically, we like to go a conventional route if you've got a larger down payment. If you've got high debt, low income, we typically will go more of a government loan where they're more conservative on like debt to income ratios.
Okay, you said qualifying income.
So very different than income in your house.
Yeah.
Yes.
So what is the qualifying?
So qualifying income is what the guidelines will allow us to use. So an example of qualifying income, if you have somebody that's a W-2 employee, they get a set base salary of $75,000 a year. That's very easy for us to be able to verify that information. You have somebody that gets a base salary of $30,000 a year, but they have bonuses of $100,000, but they just started getting bonuses in the last 6 months. Well, the guidelines require us to use a 2-year average of any type of variable income like that. So commissions, bonuses, overtime, those are considered variable because an employer can take that away at any time. So when we go into qualifying income, even though you may be making $100,000 in bonuses today, because you don't have an average of that over the last 2 years, then technically on paper, we can't use $100,000 for bonuses. We have to average it.
Okay. I had a question for that,
Okay.
but it slipped my mind.
And the other thing, so one of the other things on the on that qualifying income is also averaging it over 2 years, but also consistently receiving it for 2 years.
Okay.
So if you just started receiving a variable type income like that, and it's only been 6 months, we may not be able to use that as actual income to qualify, which would make a huge difference on the amount of purchase price that somebody would be able to borrow.
Right. Wow. I hope y'all getting all of this. Okay, so how long do I have to be on my job before I apply?
So great question. So a couple of different programs have a few different ways. You could go straight from one job to another job and qualify immediately. You don't have to be on that job for any length of time. What could come into play is the structure of your pay. So just like we kind of mentioned that variable type income, if you were a regular $75,000 income earner a year and you went to a new position that now is 100% commission, then now we have a variable rate of pay. So therefore we would say, hey, you need to be there 2 years to be able to use that because there's no history to establish what you are going to potentially make in the future. If you're a $75,000 a year earner at one job and you move straight to another job and now you're making $80,000 a year, no time restraints, no anything, because you're bettering yourself. So we would never penalize somebody for bettering themselves in that type of situation. A lot of that will boil down to is sometimes a case by case. We really need to know the whole story. We need to know the income breakdown, where we use an overtime or bonuses, commission, and now we're going to something different. We just kind of need to know a little bit more about that, but typically you don't have to wait.
So even if it's a different job title?
So same line of work. We like same line of work. So same line of work, you can be a different job title, but you could go into or different title, medical to medical. Or if you had schooling, right? If you changed and you had some type of new certification and you changed career paths altogether, we could show that you had certification and this is why you're now on a new career path.
Good. Okay. So my next one, once I've gotten pre-approved and found a house, can I finally start working for myself since my fund's been verified? But you already went to the variable.
Please do not do anything until you have the keys in your hand and that house is officially yours. And once you've heard from the lender that your loan is funded, then you can go and work for yourself. But until then, we are going to verify your job when you are sitting there at the signing table signing those documents. So don't do anything.
Wow. At the table.
At the table.
Please.
You're signing, we're calling.
Wow. Okay. So what's the difference between being pre-approved and pre-qualified?
Yes. So pre-qualified, I call that click button, get mortgage, which is not true. There's no such thing as a click button, get mortgage, right? It means that we put in the information, you told us you made a certain amount per year, and we're just going off of really just your word, right? Which doesn't mean that you didn't tell us false information. It just means that's the verifiable income part, right? So you may have said, hey, I'm Jenay, I make $100,000 a year. Perfect, awesome, we qualified you, we pre-qualified you based off of that. Then you turn around and you give us the paperwork and documentation that supports that. Once you've given us that paperwork and that documentation, we're able to verify what you've actually given us on the application. At that point, you become pre-approved.
Boom. Okay. How long is the pre-approval good for?
Pre-approval is good for 90 days. So technically what happens is we pull a credit report, and that credit report is not good forever. We know that credit changes, things like that. So we are able to use that credit report for 120 days. But that means you have to be closed in your house within that 120-day time period, otherwise it expires. So we say that a pre-approval letter is actually good for 90 days because that gives us time to finish you out and get you the keys to your house.
Gotcha. Okay, so I don't know about this one. How's my interest rate determined?
So, great question. So, when we pre-qualify, pre-approve somebody, we actually have no way of being able to lock somebody in on an interest rate. So, we may have pre-approved you, even in today's market, we may have pre-approved you 2 months ago, and interest rates were a lot lower than they are currently today. You're subject to market rate at the time that you go under contract on a home, and you're typically within 30 to 45 days from closing on that home. So at that point, we would go off of current market interest rates, and that's when we'd be able to secure your actual rate. So a pre-approval does not secure a rate, an actual contract does.
Good. Okay. So let's say I go under contract and I got a new house coming soon, and I want a new car to go with my new house because I've been wanting a new car for a minute. And then of course I need new furniture to go in my new house, new year, new me, everything.
Yes, because who doesn't want to get everything new when you buy a new house?
Everything. So is that okay?
Yeah, after you get into that house.
Okay.
Okay, so it's only after you have the keys. So go back to that part, right? Just like we're going to verify up until the day of closing, we also are going to pull a soft credit pull on your credit. So we're going to know, did you buy anything? Did anything change? Did you add any debts? So no financing anything until you are moving into that house and it is officially yours. So whatever you do, hold back, be patient, and then once you've got the keys, then you can go buy it.
Right. Keep all the new stuff.
Just wait. Just wait.
Okay. So next, what do I have? It's down payment money. I get this question all the time. I tell people, if you go FHA, it's typically 3.5% down, and I tell them that number. And they say, okay, well, I can handle that. But not realizing your down payment and closing costs is not the same thing.
It is not the same thing.
So how would they determine how much?
Yes. So that's actually one of the things that we do in the very initial steps during the loan consultation, which is the pre-approval stage. Is the very first thing is we want to set very realistic expectations. And realistic expectation is we're setting up that new buyer for success, not for failure, right? So it's not about, hey, I need 3.5% down, because you and I know that 3.5% down is not going to be able to get them into that house.
Right.
So that's just the one piece of the puzzle for the cash to close. The other piece is who's going to pay for the appraisal, the survey, the title work, the taxes, the insurance, all the actual things that we consider closing costs when somebody purchases a home. And so that's a little bit of a variable, and it will depend on the purchase price of the home, but that is something that we do in that consultation before you even start showing them houses. We want the buyer to be fully informed and know everything that they're getting into. If they're looking at a particular price point, what is that estimated monthly payment going to look like? Possibly, and the cash to close. Now, we don't know exactly because we don't have a property, but we're going to do a very realistic number in that.
Right. And I'm happy you said that, because I do also tell people to go in talking to the lender, telling them how much you want to pay a month. So you'll have an idea of what type of property you need to look at, because next $1,500 to $1,600 a month. If all I want to pay is $1,500, $1,600 a month, that's the max, because my rent is about $1,300, so I can afford a couple of hundred more.
Right.
And I want to stay in that price point. Then what kind of house can I get for that?
So that's the one question. Next question I'm going to ask is, well, how much money are we using for a down payment? Because that's going to determine our loan. So let's say you came to me and you said, Jenay, we're doing just that minimum 3.5% down payment. I'm probably going to tell you probably close to $180,000 to $185,000 for a purchase price. That's kind of where that's going to be a little bit of a variable, but it's going to be pretty close. So here's the thing, right, that I like to look at when we're looking at overall big picture, right? Is somebody could come to us and they've got a good chunk of money setting aside for a down payment, okay? And they want to keep their payment at $1,500 to $1,600 a month. Well, one of the things I look at this as a financial decision. And we may not need, if they've got $20,000 set aside, we could have maybe some other special programs that can get them some down payment assistance, some additional grants, things that will lower their cash to close. If I could take that $20,000 and I can say, hey, you know what? We can buy a house and only use $10,000 of that. But let's take that other $10,000 and let's pay off some other debts. Maybe we could pay off some credit cards. Maybe we could pay off a car. And maybe we could eliminate $500 a month in extra expenses that they're currently paying right now by using the same amount of money. So now that budget can go from $1,500 to $2,000. And so we just utilize that money differently to say, hey, a monthly budget, I'm comfortable with this, but if I can eliminate those other expenses, we make it work.
That's why you need to talk to Linda first.
Yes.
Okay, that is all we have for you for part 1.0. Tune in for the second half. And until next time, don't let fear stop you from growing. If it costs you your peace, it costs too much, because we buy properties and not problems.